Anyway, this will be much more along the lines of what you get on the CPA exam, and it'll be mailed out. Okay, next week, no new material. Now I will be here for tutoring. Anyone who wants to show up, if no one shows up, then I'll leave. But no new material, tutoring assistance only. And just a reminder, late work is accepted up until, let's say probably until Friday, um, 12/12/25 without penalty. So not this Friday, but the next Friday. Everything it's no one has failed this class yet. So you still have time to get stuff in if you haven't already. And again, next week I will be here and if you have any questions or want to go over anything, I'll be happy to do it. But everything is accepted right up to 12/12. And my reason for doing that is that the syllabus shows the objectives for the course, and as long as you meet the objectives, it doesn't matter too much when you do them, whether you do it week 1 or week 16, but as long as you do them during the course, for the course, I'm fine with it. So anyway, everything was accepted right up until the end without penalty. So if you are missing stuff, don't worry about it. Yeah, you can still turn it in. Okay, let's go ahead and finish the chapter 7 handout. And I think we got up to page 10. Okay. So the effect of entity size on internal control. I think we may have talked about this a little bit. But large clients will usually have a system large clients usually have a system of internal controls that will have evolved over the years. Does not look very. The screen looks dull for some reason. Let me do this. I'll do it like this. So they usually have a system of internal controls. A Fortune 500 company would definitely have them, but any publicly traded company will usually have internal controls. They actually will get audited on their internal controls, so they virtually all publicly traded companies, especially, will have internal controls. But even ones that aren't publicly traded will usually have pretty good internal controls. Small clients generally don't. Yeah. Oftentimes, will not have enough employees to adequately Separate incompatible duties. Okay, clean this up a little bit. So large clients will usually have a system of internal controls. Publicly traded ones are required, but even large ones that aren't publicly traded are gonna usually have a system of internal controls that they've evolved over the years. Small clients do not usually have them. They often don't have, if you only have two people in your office, we know the segregation of duties. We have the car thing, custody of assets, authorizations, record keeping. Those have to be, separated, segregated. If you only have two people in the office, you can't do it. So, there's a problem there that you have too few of people to actually have an adequate system of internal controls. And there's a couple things that come out of that, though. The question is, well, okay, well, you're required to get an understanding of internal control. Your understanding of internal control for small clients is often they don't have any. But so the understanding of internal control may be that they don't have any. They're not any controls to rely upon. Okay, so that's one of the things about it. Let me blah blah blah. So a couple more problems that come about. So the question is, well, small clients, well, maybe when they're successful, will turn into large clients. Oftentimes, when a small client to a larger client, the controls oops, let's see. What's what I'm going to say? The internal controls will lag. How about that? If they're not used to doing the internal controls, a lot of times when they start to grow, they still don't have them. So you may have a client that is moving up from being, maybe they have one store or two stores, maybe until they start growing, they get better at whatever they're doing. The camera keeps going, it zooms in and out randomly. This is, I don't know why. But anyway, so but as they grow, okay, when you have one store, it's probably not that big a deal. But as you get bigger and bigger, you go from one store to two stores to five stores to eight. So, at some point, you have to have these controls in because you're not going to be able to keep track of everything, personally as you're going to be my camera's moving again. It is going to be if they're not used to doing it. Is someone doing this? Is someone playing with my camera? Or is it just me? It's kind of fun, but anyway, um, they don't know about the controls. For instance, the idea of having a purchase order, the idea of having someone check in, the inventory when it comes in, that kind of thing. It's not there. They've never done it. So a lot of times the controls are lacking. And the reason I tell you this is that oftentimes as an auditor, you'll tell them, look, you're getting big enough now that you need to start thinking about, these internal control things. So oftentimes the internal controls will lag as the company grows. Okay. Uh, Now the question becomes, well, okay, how do you audit somebody that um, doesn't have, if they are a small client, um, of small clients will often focus on the owners. The owners will usually be in charge of all activities I should probably put a so in here. So the auditors and the owner's transactions with the business. And what we mean by that is that, money comes in, money goes out, and all that kind of stuff in the business. Now, if they don't have those internal controls, if they don't have, oops, if they don't have those internal controls that show you, okay, here's the bank deposit, blah, blah, blah. What you can do is trace, for instance, the daily sales to the deposits the owner made, possibly into their own account even, for those and to verify, for instance, the sales for the day. So you focus on the owners, and it's in the owner's greedy self-interest, basically, to be in charge of all the activities, to know what's going on. It's not always the case, but ideally, that's how you would audit them. So they don't really usually have great internal controls that you can rely on for small clients. They simply don't have enough people to do it. Um, and so you generally focus on the owners. And once you focus on the owners, you're focusing on the owners, what goes into their personal accounts, what goes in and out of their business accounts and all that, and how those all interact, the transactions with the business. Any questions on that? Okay. Inherent limitations of internal controls. They now list 4 of them. There used to only be 3. Now they list 4 of them. Okay. The first one is probably the most common one that I'll put up here, and that is management override of internal controls. So this is when management overrides the controls. There's controls in place. You don't do this, you don't do that. But management either ignores them or it uses their power to basically to turn those off. And this happens oftentimes for whether it's for a manager embezzling money or things like that, but also for especially for financial statement fraud, that they override the controls of, say, accounting. I'm gonna check something real quick. I'm sorry about that. Let's see. Anthony. No, we didn't. Never mind. There's a lot of stuff in here. Okay. So the management override the control. So for example, they may ask you to use an account. They may ask you to book sales that didn't happen. Make a, put this in as a client, as a customer, and we'll sell them whatever. And you got to make a decision whether you're going to do that or not. Uh, Ideally, we would say no, you don't do that, but we know that it does happen, and it's one of those things that once it happens once, it happens again, and it happens again, and it happens again. So it is it's a slippery stone, but oftentimes management override. It's not uncommon to have upper level accounting people involved in those things. Oftentimes other people get caught up in it too. Usually it's not just the accounting people. Oftentimes it comes from people above the accounting people. But it's one of those things you got to be careful of. And when you're dealing with people who are doing the accounting, you got to recognize that. One thing that you should do as an auditor about the management override thing is ask people, do they know of any fraud that's going on? People will sit there, people will know that there's fraud going on and maybe even be, involved in it or forced to be involved in it, coerced into it. And they won't say anything. But if you ask them, they won't lie. So oftentimes you'll ask them, do you know of any fraud going on? And they'll say, yeah. And when they interview people, like, after a fraud gets, discovered, when they interview the people, they'll say, well, why didn't you tell anyone? No one asked me, and who am I going to tell? My boss? My boss is in on it. No one ever asked me. So as an auditor, one of the things that you should do is ask people, do you know of any fraud that's going on? And oftentimes, they'll simply say that they ask somebody and they said, yeah, yeah, I know there's fraud going on. Okay. So management override of internal controls is it's probably the most common one especially for financial statement fraud. Collusion. What collusion? There are two L's in it? I think there's two L's in collusion. Maybe there's not. Collusion is what? Anybody? What is collusion? If you say that someone colluded with someone else, what does that mean?
They both work together.
Yeah, yeah. And notice, that if you have somewhere here, here, you have these segregation of duties or incompatible duties. If you have two of these people get together, it becomes very difficult to find that. So collusion is one of those things that is is when two or more, I should say. Two or more people get together to defeat the internal controls. So collusion when two or more people get together to defeat the internal controls. And it becomes very difficult when they do that. By the way, when I was a U.S. Steel and Navistar, the Treasury Department, people involved with cash, were located miles away. So you have these headquarters, and the Treasury departments for both U.S. Steel and Navistar, the Treasury departments were located miles away from the rest of the headquarters. But both of them were about 10 miles away. So, I mean, not only were they, not only were they divided by department, but physically, like, we don't want anyone meeting, we don't want you meeting the Treasury people. Now, maybe some company functions or something like that, but we don't want this daily thing of people meeting together because it can be dangerous, especially if accounting and treasury. If those two people get together, I mean, it could really lead to big problems, and it'd be very difficult to find because you wouldn't be looking for anything because the missing cash or whatever would be covered by the accounting people who could do the journal entries and those sorts of things. So they were physically about 10 miles apart in each case. They're far away from, and it's simply because to avoid collusion, because it could be, literally millions of dollars could disappear without anyone noticing it. Okay, so there's also errors or mistakes in the operation of the controls and in the design of the controls. And they separate those out. Those used to be the same. So errors and mistakes in the operation of the controls, and errors and mistakes in the design of the controls. So errors in operation, errors in design, and they kind of separate those out. Those used to be the same, but and there are different ways of combating it. Errors in operation, obviously, training is one of those things. And errors in design is actually part of the internal controls for putting stuff into the system. Usually are what we're looking at. And by the way, you hear about, these people, someone worked at a bank and the accounts get rounded off or whatever. And they have all these talk about people getting into the programming. Yeah, that should never happen. And it should never happen in a business, especially. We have controls in accounting. Generally, if you're a staff accountant, you make journal entries. Those journal entries are sent to an accounting manager, possibly a controller, depending on the size of the place. And my camera's moving again. And so before those journal entries go into the system, someone looks at them and then says, "Oh, okay, these journal entries make sense," and they approve those. So you don't just, as an accountant, generally, if it's a larger place, anyways, you don't just put stuff in the system. You make the journal entries. The journal entries go to a manager, and the manager actually does what they call the posting. They'll take those journal entries and say, okay, these make sense, and post them into the system. So there's someone looking over it. And the same thing goes on when it comes to systems. That when someone writes a line of code, they don't just lump it into the system. Those lines of code will go to a head programmer, someone along those lines, higher up in the IT department, who must approve those before they go into the system. And obviously for a number of reasons that they can, and to make sure that those lines of code will not affect other things and all kinds of stuff that goes on. So there's an approval process that goes on, and it's the same thing, and so oftentimes when you have problems with it, is because of that there isn't that oversight to it. Or it could also be that the oversight isn't working. Someone just keeps putting through. We actually wrote an audit point on that, but the guy that was approving everything wasn't reading any of the journal entries. But anyway, okay. An associate, the client's associate treasury director and staff accountant colluded to embezzle thousands of dollars from the client. How could this situation have been avoided? I'll tell you which one it's not. The Treasury Department will prohibit them from accessing cash. Well, that's why they're there. They're there to pay out cash and to, um, collect cash and all that. So this is not it. They have to do that. That's their job. It's accessing cash. So how could this have been avoided? Give you a hint. It's a trick question. Anyone? Take a stab at it? How could this have been avoided? Someone says, oh, this is terrible. This can't happen again. We're gonna, have to really clamp down so that this cannot happen again. All right, I'll tell you. It cannot be avoided with internal controls. It's a limitation. It's collusion. It's a limitation of internal controls. You cannot eliminate it. I mean, you can try keeping people separated and all that kind of stuff, but to say that this could be avoided is not really a solution, because it actually is a limitation of internal controls. Lie detector tests, well, first of all, they don't work, but second of all, that's not going to catch anybody really. And installing cameras, they probably don't get together at work and hang out. This is, if they have any kind of common sense, they're not doing that. But anyway, yeah, it cannot be controlled by internal control. People talk about, how do we eliminate these things? How do we make sure that management can't override the internal controls? The limitation. You can't change it. If you eliminate fraud, I say, well, first, if we're going to eliminate crimes, let's start with, murder and all those, and then work down to. Okay, is this all on the same page? Did I do something wrong here? I must have. Is number 8 all on page 11 for you guys? Oh, I probably made this too big up here. I'll get some room back here. Okay. And yeah. Material deficiencies are reported to management and the audit committee, and they are written. Significant control deficiencies, and I'll talk about this in a second. There's actually something kind of strange about that one. Also must be reported to management and the audit committee. They must be written. less significant are given to management usually. They're usually written, not always, but they should be written. If it is a publicly traded company, the less significant control deficiencies are still given to management, but let me put down here. If an issuer the audit committee must be notified of this. And what I mean by that is the audit committee must be notified that you have given less significant control deficiencies to management and who in management you gave them to, so that they can follow up if they want. So, and this is for issuers. So for issuers that the audit committee is notified of those, they are not told what the deficiencies are. They're not given a list of deficiencies like management would be. But they're told of them so that management can give those deficiencies to the audit committee. And if you're wondering, say, well, why don't they just give them everything? Well, because you don't want them sidetracked. You know, it might be something that they might focus on that has nothing to do with, you know, the audit or anything like that. So anyway, yeah, sometimes you pick and choose what goes to them. Certainly everything that is significant or material. I know what I was going to tell you. When it comes to the, I'm going to get some room here. Material deficiencies are by default also significant deficiencies. Oops. Eh. Okay, you say, well, that's kind of a weird thing to say. Why do you put that down? Okay, well, material deficiencies are a higher are worse than significant deficiencies. However, an awful lot of the auditing standards, they'll talk about significant deficiencies. If it is a significant deficiency, if it is a significant deficiency, this, that, the other thing. And people think, well, does that mean that material deficiencies are not included? Yes, they are. So material deficiencies are by default also significant deficiencies. You know, they're worse. The worst deficiencies are material ones. Let me put that in. Material deficiencies are the worst. And these ones are, let's say, bad. They're not as bad, but they're bad. So if they say it's a if significant deficiencies, you know, whatever the rules are, that also applies to material deficiencies. And you'll see a lot of the standards are written towards this significant deficiencies. They won't use the term material. It's given that if it's material, it's also significant. Questions on that? That's actually come up. That's been a CPA question a few times. Okay. Oh boy, this is a mess. Hey, let's do it though. All right. Yeah. So any question that, by the way, less than significant ones, they can also be given orally, usually not. They're usually given, they're written. And by the way, one of the reasons why the lesser ones you also give to management, people say, well, if they're insignificant, why were you doing this? Well, because management may want to, even though it's not significant for the financial statements, it might be still something the company wants to keep track of and wants to, not do. Someone stealing $1,000 a week from Walmart, obviously insignificant for the external audit. But you may want to tell them, look, there's someone stealing $1,000 a week from you guys, and this is how they're doing it. So even ones that are insignificant, you may want to tell them, and they may very well may ask to see all of them, obviously. Okay. Um, okay. Yeah. Let me. All right. Let's go ahead and just do this. We'll finish up the last one. I was going to throw something else in, but I didn't want to stop it. Okay. So the internal control report. This is for publicly traded companies. This is for issuers. Oops. You can have an internal control audit if you're not an issuer, but usually they don't. They're expensive, and also a lot of times companies that are not publicly traded are smaller companies, and maybe they don't have internal controls, or very few. Not often are they developed as well. Okay, so it is possible that you combined the opinions. So here's your two options. Say, I got another color here. I'm going to steal this color. Okay, option one, you have two separate opinions. You have an opinion for the financial statement audit, and you have one for the internal control audit. You can also combine them. And the combined report will have two separate opinions, and they don't have to be the same. So the opinion for the financial statements might be a clean opinion, and maybe you have an adverse opinion for internal controls. So, just because the financial statement opinion is a clean, unmodified opinion, or unqualified, it would be the term that they use for publicly traded. Just because it's a clean opinion for the financials does not necessarily mean the internal controls are clean. Get a clean opinion. And remember, internal controls don't necessarily mean the financial statements are misstated. It's possible that there's an internal control that is not actually generating, dollars that are being, amounts that are material, being misappropriated or put in the wrong accounts or whatever. So you're going to have two opinions either way, but you can have them separately or together. It used to be that these were very, very rare. These the two opinion, you almost never see them. Now you see them more and more often, but they used to always combine them. So you will see these more often now. Have them separated. For conditions, I'm not going to probably go too far into this, but management must accept responsibility. That's been required for a million years. I'm gonna undo that. So management actually evaluates the effectiveness, and they have to have support showing that they are doing what they say they're doing. They must have a sufficient appropriate evidence. And management must do their own written assertion. Now, here's the thing about internal controls. If you're doing the internal control audit, you must also do the financial audit. So the financial, this thing's falling away. The financial audit is required if you're doing the internal control audit. However, you can do a financial audit without the internal control audit. I know that sounds strange, but those are the rules. So it is possible for a company to have a financial audit and not have the internal control audit. Now, if they're publicly traded, when they get that internal control audit, they have to have a second financial audit because they have to go, they have to be done together by the same firm. So the internal control audit requires a financial audit by the same firm for them to issue the report. And here's why. They might discover things during the financial audit that would lead them to believe that there's problem with internal controls. Identification of materials for during the financial audit, discovery of fraud. That one's can be separate, and so could this one. But these are things that show that there could be material weaknesses. They discover fraud of senior management, that could be a material weakness, and identification of material misstatements. You find material misstatements, well, there's probably some problem with the internal controls. Material or significant deficiencies by the report release date. And for governmental entities only, the written communication must occur within 60 days of the release date. And if you're thinking about, well, what is our government? It's not going to make that big a deal. You know, what does that have to do with anything? A lot of companies will have government contracts, and a lot of times those government contracts will be part of the audit. And so any control deficiencies that are discovered during the audit must be reported to the government as well. Lesser deficiencies. Written management within 60 days of the report date. So deficiencies that are not material. And those will be communicated in writing. Now, if this is if it's a publicly traded. And communication, well, it's publicly traded, but it's also during the internal control audit. The auditor, this is true for whether you are a issuer or not. The auditor should not issue a report stating that no material weaknesses or significant deficiencies were identified. This is actually very important. So important that I wrecked it by doing that. You cannot give any kind of a statement that the company does not have any material weaknesses or significant deficiencies were identified during the integrated audit. And the reason is that it's a process, you know, and so as any process, if something stops, it stops. If people stop checking the invoice amounts and start paying, those internal controls go away. So you can't make the statement. It's a process. It's like, saying, oh, Joe's riding a bicycle. Riding a bicycle is a process. Joe might not be riding the bicycle right now. So you cannot give any, and it wouldn't be unreasonable for someone to say, look, I'm paying all this for this audit. Can you give us something in writing that we can show to shareholders or something saying, look, they have no material weaknesses in internal control. You guys just went through it and you didn't find any. You can't do that. First of all, bell curve. They may have missed, if you're doing this to the 95% level, there's a 5% chance you missed it. But also, even if you believe it, it's a process, and it's one of those things that it could be there. At the end of the year, it should have been there, and if you signed off on the report and said everything's good, then at the end of the year, you should have believed those internal controls were functioning as planned. But you cannot give a written statement or any kind of a statement actually that says we didn't find any internal, any material weaknesses in internal control or significant deficiencies because it's a process. It's not like the financial statements that it's here in black and white. Is at the end of the year, everything's down. It's not going to change. Internal controls can change. Okay, I think that's it for that one. And yes, it is. So you cannot say that there are no material weaknesses or no significant deficiencies. You cannot give that assurance to them. They said, we just paid you a bunch of money and we did. Okay, so let's save that. And next thing we'll do, let's say be back at, time is it? Oh, 7 o'clock. We're down to the last hour of the class. You guys excited? I bet you are. Be back at 7. You can hear the little dog beating up the big dog upstairs. So I'm gonna go see what that's all about. Okay, so be back at 7. Okay. The little dog was beating up the big one, but the little dog actually, it's kind of funny because she has two bad legs. And I actually I spent $9,000 at surgery on and it didn't help on one leg. But anyway, you think this dog would like, tiny little dog with two messed up legs would not be attacking the other one, but she does. Okay. Um, we've gone over this before. I'm going to do it quickly for the AICPA one. Um, we talked about this earlier in the term. Uh, We have an opinion. It's based on, we our responsibility is to issue an opinion. They go into great detail about what's included in an audit. Talk about managers' responsibilities. They're responsible for the financial statements. All right. Reasonable assurance. We talked about all this before. Oops. Okay. Coming down here, one of the things that is sometimes tacked on to the audit, and that is the key audit matters. Key audit matters are those things that are communicated to, for instance, the audit committee. So, we talk about communicating to the audit committee about internal controls and material misstatements and all this kind of stuff. It's possible you put those key audit matters, tack them onto the report. Now, this is usually stuff that's only given to people on the board of directors. And specifically, if they have an audit committee, the audit committee. So key audit matters. Now, this is for non-issuers. So for non-issuers, key audit matters can sometimes be tacked on. Now, these are not just given out to the general public usually, but if you got like a large bank or something that's floating a large loan, or you have investors, let's have some kind of autofocus thing coming in here. Just start it. Oh, audit frame my video. Let's turn that off. Hey, I'm back. How are you guys doing? Uh, so key audit matters. So the bank, they have a genuine interest in these things that are communicated to the board of directors saying, look, this is a big loan. We need to know this stuff. It's not for the general public. Usually it's for specific, say, investors or lenders that they can actually see these, whatever communications you have with the audit committee, especially for things like, in the audit, okay, we did find, for instance, controls over cash. If you're a bank lending somebody money, you want to know that there's control, the controls over cash are, adequate, or that at least didn't find anything. So it makes sense that they would want to see those, notes related to that. So key audit matters are those things that they can be tacked onto a report. These are only for non-public traded companies, and they're usually for big investors, big lenders, to give them some kind of comfort as far as what is actually going on with the place. It's signed by the audit firm, date of the audit report, and the city and state where it's issued. I think we mentioned this before. I'm not sure. This is the last date that the auditor is on the hook for searching for items. Okay, let me do something. So the date of the audit report is actually very important for auditors. At that date, we are no longer on the hook. So for instance, if the date is 2 dash 5 2026, that means if something happens on the 6th of February, we're not on the hook for it. It's not, it's one of those things you got to close the audit at some point. And so that's the date. It's not the date that it's issued. Usually this will be issued after this date. It might not be issued till the 14th or something. But this is the last day of field work, last day of looking for things. Okay, now this is the one that we did not do. Public trade companies. This has got the unusual name of unqualified. It's not really unusual, but it's saying, look, everything is okay. We're not putting any qualifications, no except fors or anything like that. Pretty much the same, a little bit trimmed down from the AICPA report. Not as much description, but basically all the stuff is there. One of the things that they have that's new, and this is what you would be tested on the CPA exam if it comes up, are critical audit matters. These are things that relate directly to the financial statements. So critical audit matters are those things that concern the auditors enough that they want to tell the public, by the way, this is what we were led to believe, and it'll explain why they were led to believe that and what, I shouldn't say led, that sounds like it's bad, but why they made that determination. For instance, well, I'll tell you something that's kind of, some things are very much judgment oriented. For instance, artificial intelligence. It's a big thing right now. It's a big boom right now, and it's taking over this and that and the other thing. There's a lot of this stuff is kind of petering out, though. A lot of it is not what they thought it was going to be. Now, when they're investing millions and billions into this AI, and those are making what are assets as far as software and patents and all that other stuff, that's under the assumption that this is going to get bigger. Now, again, these are billions of dollars, and so it's very it's at least possible that it doesn't come to anything. That artificial intelligence is one of those things that's been around. It's been around since the 80s. It was a big thing in the 80s. Oh, the computer is going to have artificial intelligence. There's not going to be any more accountants. In 5 years there won't be any more accountants because of computers. They were talking about that in the 80s. This has come around before, and when you're under that assumption, that these are going to be positive cash flows in the future, that's a big assumption. And again, these are billions of dollars. So there's a lot of things that you might want to put in there and say, by the way, there are some risks here, and there's not a lot you can do about them. And this is what you have to do: identify the matter, describe the principle that it in determining it, what accounts, and how you came about your decision. So there's actually 4 things about it. You identify it, what the consideration, usually the consideration as far as the accounting is concerned, what accounts could be affected by it, one of the client's accounts, and how you came to your decision. And again, this is a clean audit report, so you know, it is possible you have these cams that look pretty serious, but it's actually. Everything's the same here except on the other one, with the exception of this. You have to tell how long you've been auditing for them. Okay, let's play. One of these things doesn't belong here. So here's a standard report for a non-public, non-issuer. Which one of these does not belong here? Which one does not go into the report? Anyone? Which one of these will you not find in a standard report of a non-issuer? Give you a hint, we just talked about it in the last handout. You guys are sleeping, aren't you? You guys are sleeping or you're watching the cat play piano on YouTube. Anyone? You can put it in chat if you want. Tell you what, if someone shoots out an answer, I'll put it on the test. It'll be a free, it doesn't have to be the correct answer. If anyone tries to answer this one, I'll put it on the test. Actually, maybe I'll put it on the test anyways. But if you if you shoot out an answer, I'll give you the correct answer to it. All right, well, let's go to the next one. Yeah, go ahead.
Are you on number one?
Yeah,
Is it C?
it is C. Very good. Yes, it is. And I'll put that on the test, and you guys will all know that. I'll write that down. Put it on the test. Okay, let's go to the public traded company. This one's a little tricky. Yeah, we're gonna eliminate some of these that we are gonna say we're not in. Manager's responsibility, that is on there. So that one's not, put those in red. Don't do that. Yeah, so they always say manager's responsibility. These financial statements are the responsibility of the company's management. We also say independent registered public accountant. So going down here, that one is included. And they also talk about the registered accountant's responsibility. Our responsibility is to express an opinion on the financial statements based on our audits, but here's our responsibility. Yeah, maybe make it a different color. You don't want to be lumped in with management. Hey, it didn't change. Try that again. There we go. And by the way, I don't know if I told you this. When I was taking the CPA exam, we would memorize it. We had to memorize this. And you memorized it for a couple. You knew it was gonna show up on the exam. This is before we had the critical audit matters. But you basically memorize this whole thing. And one of the reasons was you get questions like this. And sometimes they actually had the exam where they'd say, write the standard, they were all called unqualified reports back then, write the standard unqualified report. And if you memorized it, you probably passed the exam. If you didn't memorize it, you probably didn't pass the exam, but that actually showed up a couple times. And they wanted you to write it verbatim. So it's between B and C. So these are the two decisions. Reference to the AICPA auditing standards or reference to the Public Company Accounting Oversight Board. Which one of these is not on the standard report for a public company, the issuer? This report, the report on page what is it? 3. We conduct our audits in accordance with the standards of the PCAOB. All right, so now, which one is it? Which one of these is not on there? It's the AICPA reference. This one is not on there. I'll put this one on the test too. So yeah, this is the it's not on there. The AICPA standards. Now, the AICPA standards and the standards of the PCAOB, originally they were identical because the PCAOB just took all the AICPA standards, but now they're a little bit different. Not much, but a little bit. And they reference the PCAOB standards on the report. They do not on, these are not on the report. Oops. Okay. Emphasis of a matter. These are things that are already reported, but we want to emphasize those in a report. Okay, so making big obnoxious capitals. These financial statements and or footnotes. Oops. Okay, so these are things that are already included in the financial statements. and or the footnotes. They're usually in the footnotes. Okay, a going concern. This is when a company is likely to go bankrupt within the next couple of years, let's say. So going concern opinion. Oops. I'm going to modify that a little bit later on, but so this is when a client is likely to go bankrupt within a couple of years. Now, here's the thing. Um, did we talk about this? Can't remember. So going concern paragraph. Sometimes they're just called going concern opinions. Notice that a company going bankrupt, their financial statements are going to look bad, right? And in the past, they would say, well, you got to look at the financial statements, and you can make a determination if you think they're going to go. And so sometimes it was obvious the companies were going bankrupt. They were losing cash and they weren't getting any money coming in. So they're running out of cash and they're going to run out of cash within a year or whatever. When a company go bankrupt, though, you have this awkward moment where people would say, wait a minute, how come the audit report is a stamp of approval, unqualified or unmodified report, and yet they went bankrupt? How can that be? Well, we don't give the stamp of approval on the company as an investment. You give the stamp of approval on the financial statement saying, look, these are, we have reasonable assurance that these are free of material misstatement. That's all, that's the audit. But people get mad because they say, if the company goes bankrupt. So this going concern thing became big, and it's really big now. And it basically says that the auditors have a duty to tell people, oh, by the way, we've already reported the terrible financial statements. Those are all, you can read the terrible financial statements. However, what this means is this company could go bankrupt within the next, year or two. So they come right out and say it. Now, when the auditors do that, it's required that the companies also put it in the footnotes to their financial statements. So it is reported by the client, it has to be, that they could go bankrupt. So it's required that they put those in the footnotes if the auditors are, and the auditors reference the footnotes saying, by the way, in the footnotes, you'll notice that this company is likely to go bankrupt, or there's a good chance they'll go bankrupt within the next year or two, or whatever the time frame is. So this is it's an area that for years the AICPA kind of ignored, and then they said, well, wait a minute, people are getting mad about this, but we do have to see whether we are give some kind of reasonableness of that this company may not be around. So they have to put in, so that's why it's an emphasis of a matter, because it's already been reported. But auditors are required to put it in the report, even though it's already in the footnotes, and they're also required to do these calculations to see. One of the things that comes about it, though, is that a company, just because a company's doing bad doesn't mean necessarily they're going to go bankrupt. Just because they're not making money, they're not profitable, doesn't necessarily mean they're going to go bankrupt. So it's possible they have a plan. Now, if they have a plan that looks reasonable, we're going to do this, this, and this, to get them out, you, as an auditor, you can look at those and see if those are reasonable things that they can do that it looks likely they can do, and take that into consideration. And so it isn't a static thing saying, okay, everything's going to continue the way it is today. If the company is actually taking steps to avoid this, we're getting financing from these people, we're doing this and that, whatever. But two things that come out of this. First of all, the public is made aware of it. The banks are made aware of it. Investors are made aware of it. It's called a going concern opinion. Another thing that came about it is that there were some companies that had no idea they were going bankrupt. And there was like an airline that, I think it was Deloitte, made the audit report on it, gave them a going concern. And they said, well, Deloitte's wrong. We're not going bankrupt. Here's what we're going to do. We're going to sell off these airplanes. We're going to sell off these routes. We're going to, concentrate on this route's profitable. We're going to, cut it. And Deloitte said, well, if they had that plan in place when we did the audit, they wouldn't have got a going concern. So it does make, and again, they were kind of caught off guard. Really, we're going bankrupt? But anyway, but the whole idea is that you let the public know that it might go bankrupt. Okay, so, and this one's a little bit tricky. All of these are true except for this one. This one has changed. It's not within 1 year. For the US, it's at least 1 year. It could be more. Could be 2 years or 3 years, whatever. International standards are 2 years. They say for the next 2 years, you have to make to see whether they're going to go bankrupt for the next 2 years. US standards say at least 1 year. And the idea being that, it has to be more than a year that you're doing this over. Okay. So that is a going concern. And again, this is something that's already been reported. Emphasis of a matter, change in accounting. So accounting principles not consistently applied. Hey. And this is a very, very common one. Whenever a new accounting rule will trigger a not consistently applied emphasis. Oops, a new rule, I should say. So a new accounting rule will automatically trigger it. Why? Because it's new. They didn't do it last year. So if you have a new rule, you say, okay, it's not consistent. Last year we didn't have this rule. We weren't following it. Now there's a new rule. We will follow it. So it's not consistent. And this is very common. I saw a company one time that had 6 of these. They had 6 of these accounting standards not consistently applied because they had a whole bunch of new rules come out. So it's not unusual at all. Okay. Has which of the following characteristics? It is not about an accounting estimate. Estimates are not rules. Accounting estimate says this piece of equipment is going to last for 5 years and maybe it changes to 8 years or 4 years or whatever. That is not, the principle is consistently applied. That is an estimate that has changed. Unacceptable accounting rule. No, it's not for unacceptable accounting rules. They can't use unacceptable accounting rules. Must be used even if the financial impact is immaterial. No, it's not material. They don't have to use it. If it affects Whether they depreciate a stapler or something, it doesn't matter. This is the one that they're looking for, and this one is, they've highlighted yellow. It's often done, even if the new principal, even if management has justified that the new principal is preferable or that it's required, they still get this. It's just to let the reader know, by the way, this has changed. So even though it's already reported, it'll be in the footnotes. It'll be in here. Both of those will be in there. So you have a new accounting rule for whatever, depreciation. New accounting rule for depreciation, it'll be in the footnotes. This is how we depreciate it, and it will also be in the audit report. I think I'm going to, well, let's see, what is this other matter? I'm going to just briefly talk about other matters. These are things that are not required. Actually, I take it back. One of these is. Yeah, one of these is required. We'll go through these. Other matter, these are things that are audit discretionary. Actually, this is not 100% true. Talk about it in a second. Other matters, so if you have something about uncertainties in here, uncertainty out of the matter, the uncertainties that we're talking about here are usually unusual uncertainties. We're not looking for run-of-the-mill uncertainties or ones that can be estimated. If they're estimated, they should be in the financial statements. Other matter issued for additional circumstances, maybe all the following. Additional circumstances are things that happen outside of the normal financial statements. You would not report this on an inventory item. You can't verify this inventory item. That is not what they're talking about. They're talking about things that happen after. So you have a major catastrophe. You have in February, you have a hurricane that wipes out your business or whatever. That's the kind of thing that you would put in there. This one, group auditor, I don't know if I should talk. I'll talk about it. It is a little bit of a. This is one of the times that the international standards I think are better than the U.S. standards. Okay, I'm just going to talk about it. Suppose we have a company that it's based in the United States. However, they got a significant amount of business maybe that goes on in Italy. Okay, so they really have two different areas that they're dealing with. So let's say the US market, is 80% of their business, but maybe 20% of it's in Italy, whatever it is. Okay. You're doing the audit. So you have the significant part of the business that's over in Italy. What do? Unless it's just dumb luck that you have a bunch of auditors in the United States that speak Italian. It's going to be really difficult to go over to Italy and get interpreters and all this kind of stuff and spend all the money on travel, spend all the money on putting people up in hotels and all that kind of stuff. It could easily be more than the rest of the audit combined that, to go over to Italy. So what you do is you contact the equivalent of a CPA firm over in Italy, and you say, hey, we got this business and we'll, pay you X amount of dollars if you can do these things for us. And, these will be included in part of the audit. That you test the sales here, test the deposits and all this kind of stuff. So you contact another CPA firm and have them do it. Now, in the United States, you have the choice of listing them separately or taking the entire responsibility for the audit on yourself. International standards say you can't list them separately. Your name is on the audit and that's it. You can't. And actually, many US clients insist on that. But there is the possibility that you could actually list them separately. And that would be what this is. So it's when you're using another CPA firm. The group auditor is the big one. And the component is people who are the audit firm over in Italy that's doing it. Now, the component auditor might be bigger than the group auditor, but they're doing a smaller part of the audit usually. Okay. The auditor may decide to share responsibility. If it's not shared, they have to do additional work. True. This one is not true. The materiality may not be the same. So you have the subsidiary over there, and they might be, again, maybe a quarter of the size. Their materiality is going to be different. It is possible also to have two different opinions. What might be material to the smaller subsidiary may not be material to the larger company. Microsoft owns a business over in Italy, and maybe the financial statements are materially misstated for that subsidiary. Maybe they're misstated by $5 million. Maybe it's significant or material. To Microsoft, $5 million is not significant. So even though the audit is done and there's not a report that is maybe adverse, to Microsoft, it doesn't matter. If you win 5 million, that's fine. Okay. And I am going to jump ahead to the scope limitations. The last thing we're going to cover, the last thing. We already talked about the material misstatements and all that. Scope limitations. This is when there is something that you can't, there's information you can't get. And they used to come in 2 categories. Now they come in 3. And why am I jumping ahead to this? Because since they split these up, that means that it's fair game for the CPA exam. Okay. Client imposed limitations. This is when the client refuses to allow the auditors information that they need for their audit. Oops. Client refuses to give access that they need to. Now, there is a materiality issue here. If it's not material, it's possible that it doesn't matter. But if it's not material, you shouldn't be asking for it in the first place. I should say if material. is a cause. What would you cause a disclaimer of an opinion? Usually. And again, if it's material, if it's not material, you shouldn't be bothering with it anyways. But there sometimes we will say, well, if it's not material, you can, do something else. Yeah, but if it's not material, you shouldn't be bothering with it. So you only look at material things. Okay. This is the new one. Did I not highlight that whole thing? So this is also a client imposed. However, this usually comes about because it's after their year end. And oftentimes it's because there's a problem. Maybe their previous auditor can't do the audit. They didn't know they needed an audit, whatever it was. And this one is a little bit softer in that oftentimes the client, while it is because of the client's actions, it's not it was not their aim to have this scope limitation. So for instance, year-end inventory. That little dog that has two broken legs is now barking at something, barking her little head off. Okay. So the client's intent was not to limit. So for instance, the bank now says that they need an audit. They didn't get one at year end. They contact the audit. So again, we can't jump in the time machine and go back. We possibly could back into the inventory numbers, but again, this one is different in that it was not generally the intent of the client, even though it's due to their actions, it wasn't the intent of the client. And this one may get a disclaimer of an opinion. Oops. Or a qualified opinion. So we're giving a little bit more leeway in this one, even though it is a client imposed. And circumstance can impose are things beyond the client's control. Examples. Um, Fires that destroy records, accounting records. All the computers that were stolen. Inventory. That's being held by police. Access denied to a warehouse with inventory, things that are beyond their control. And this one is also get a disclaimer or qualified opinion. Okay. And which one is the worst? Client says you cannot talk to my lawyer. That will usually get you a disclaimer. And we talked about this. The scope limitation is deemed. Now remember, scope limitation does not necessarily mean that anything is misstated. This means you can't get the evidence. So limitation is deemed possibly material and pervasive. We'll get a disclaimer. Possibly material but not pervasive. You actually have a choice here. You may get a qualified out of it. You may also get a disclaimer. You probably want to go with a qualified. Qualified says everything's okay except for, and usually, especially like things like the balance sheet would be okay, or something like that. Scope limitation to be not material and not pervasive gets clean opinion. We're done. 11 minutes early. So that gives us time to go see who the little dog is attacking. The little dog with two legs, two working legs and two not so good legs. Any questions? All righty. Well, hey, that's the class. Next week is optional. If you want any help with anything, I'll certainly be here and help anyone who comes. Otherwise, that's it. I'll send you out the test tomorrow, and that will be it for the course. Any questions?
Thanks, Professor.
Okay. Hey guys, see ya.